I think today we are going to discuss, keeping the audience of various places in mind, since it is related to IT professionals, moreover. So I'm going to do this session in English, like most of our sessions are in. So I'll try to cover in the next 40-45 minutes about a proper financial planning, which we are expecting for the IT professionals to have, and also some of the issues faced by them. And all questions will get answered at the end of the session. So you can either make that the questions typed in the system, or you can always message to us as Ms. Soumya was talking to you about. So let me move on with the subject for the people who have just joined now. This is going to be the agenda we are going to discuss today. The common issues, financial issues faced by IT professionals, and goal setting, inflation, and risk appetite, which each one of them carry. Starting early in financial planning is an important aspect of life, and we keep listening to stories of India growth story, and we're going to check today whether it's going to work. I mean, is it in real? Are we benefited out of it? And the most important, this hard-earned money, what we have from our job, is it getting safely and securely maintained, safeguarded against the frauds and risk associated with the industry? We're also going to discuss about risk mitigations, which we need to plan in our life from different kind of risk associated with life. We're also going to discuss about some of the like Soumya said, retire early is a dream of everyone. So are we equipped to do so? And we are also going to cover on tax efficiency. So these are a couple of topics which we are going to cover in detail by slide, giving you more information and research data. So all our presentations and seminars are just not verbatim. We clearly have data backed up slides, data backup to tell you that why we are saying so, and with the reasonableness of logic and reasoning. So we'll keep it moving. And today there is a common issue which faced by not only tech professionals but also anyone for that matter: work-life balance. We also have an insecurity most of the time about the job and competitiveness of the market, right? Diverse skills which is required today. We also getting paranoid or worried about our risk, skill sets are sufficient for another 30-40 years. And we also get concerns about mental health and stress management related issues. So here there is no reference to any particular individual. We just given this name to tell that the recent issues of stress related aspects which each of us going through, and possibly thereby financial management become much more important in our life to plan properly. So these are the common mistakes faced by, or common issues faced by us in terms of managing our money. So one is lack of discipline. You can associate with some of it, saying that spending nature is different for each one of us. Especially we've seen tech professionals in the early stage when they get a large sum of money. The tendency is to spend more, have a different lifestyle, and take loans, take credit card exposures, and not having sufficient saving. There is no emergency fund. This is one aspect we have noticed. So people generally tend to spend whatever money they get, and people generally tend to leave everything else to chance, or having more confidence on the profession and professional income. Lack of diversification is another thing which we have seen. People have just one set of ESOP stocks, which company provides, or ease of doing, people just put it into a fixed deposit and forget about it. So lack of diversification is clearly an area which is identified by us or any finance professional related to tech professionals. Chasing hot trends. Yeah, we all live in a world of equally connected. So when social media comes and tells that a cryptocurrency can give you 10x return, we tend to jump into it. When somebody says algo trading can give you immense wealth, right, we tend to jump into it. Gaming apps and so on and so forth. So there are clear signals of people losing, their hard-earned money following the hot trends. We also seen inadequate protection. We generally do not pay attention to one life, related discipline and also health related discipline. So what happened today? Life is so unpredictable. So much of emergencies which we face every day in and day out, and we have also professional liability comes at some point in time. So are we adequately against those life and health related concerns? Another thing which we face is inadequate tax planning. So people just keep money in the fixed deposit or NCDs, or just keeps it in the savings account without even realizing it's low yielding and it has a higher taxation. So the tax prudence wise, tech professionals, we see them lagging behind in terms of taking tax advantage or tax efficiency, which governments are providing. Last but not the least is, again, if we have to, I was just telling in the recent one of the seminar that if we require a software to be developed, where do we go? We come to you. If we have a mental illness, we go to a psychiatrist. We have a physical illness, we go to a doctor. And for finance alone, we try to believe more on the social media and try to, and neglect the risk associated with it and get into scams and frauds, etc. So just to sum up on the common mistakes or issues faced by IT professionals, one, we can say lack of discipline in following that investment financial management, lack of diversification in terms of following a proper diversified asset classes as part of their investment, chasing hot trends in our endeavor to make a quick money out of it, inadequate protection. We hardly protect our risk associated with the life, health, critical illness, liability, etc. Tax efficiency, we don't seem to be paying attention to and not seeking professional advice as far as financial management is concerned. Now, couple of small tips which we're going to learn today. One, we often heard that income minus expense is equal to saving. We generally believe that that's the way it should be, right? Income from the monthly income, whatever spending we do, remaining, if anything is left out, we tend to save. But as part of the first discipline in financial management, we must learn that income minus saving should be your expenditure. So that saving, whatever savings we chase, whatever saving we would want to have it for future, whatever retirement plan which we have it in future, whatever goals we have set ourselves in future, all can be achieved through that fixed saving which we allocate every month. I remember my parents and I remember many of the parents first used to give time for saving. Whatever the money left out after the necessary saving, which can be 10%, 20%, 30%, depending upon each one of your income level, the remaining amount gets used for different spending at home. So please learn this message that income minus saving should be equal to expenditure, not the first one. Create smart goals. So many people think that dreams are equal to their goals. Dreams are not equal to your goals unless dreams are converted into specific, measurable, attainable, and time-bound activity. Which means whether it is a short-term goal, short-term dream, or a medium-term dream, or a long-term dream, unless it is backed by a proper financial plan, unless it is time bound and measurable, unless it is specific to the last leg, it may not be called, it should not be called as a goal. So, dream will, we will have to, as a tech professional, convert dreams into goals. whether it is buying a car or taking a holiday elsewhere, or is it getting about self marriage or children's marriage, or self education or children's education, or even having your retirement plan. Make your dreams into proper goals. Third lesson which we are going to learn today is inflation is an invisible enemy which work against us, against our purchasing power. So India's average inflation for the last 10 years is reported as 6.01, and last few years it has been much higher than this. You don't have to go anywhere to learn what is inflation, whether inflation impacts you or not. Just go to fill the fuel. You will understand that how inflation is impacting you. So your 100 rupee today or a 500 rupee today can't buy the same goods next year with the same 500 rupees. So your purchasing power will come down or the cost of the goods will go up, for which you will have to keep it in mind your income, whether from the work or from the investment or from your financial management, need to grow better than this inflation to maintain or to improve the purchasing power. Many of us believe that saving money is equal to investing. As this picture shows, saving is equal to setting a certain money aside. It's just like putting in some money into a piggy bank. It doesn't create an income from there. It doesn't grow. But investing is when your money is able to produce result to you over 1 year, 3 year, 5 year, 10 year period of time. So ensure that your money is just not saved, but it is invested. Thereby, it creates additional income for each one of you at the desired time. So saving is just not enough. Investing is the idea. Investing is the growth engine. Having seen inflation, having seen the difference between investment and saving, we are now going to tell you that starting early is important. The power of compounding. Here in one of the examples which mentioned here, a person is starting his financial goal with a 5,000 rupees, expecting a 12% return and doing it for 30 years. So here, three things. Amount is fixed at 5,000, return is fixed at 12%, time is 30 years. He possibly will achieve a corpus or a surplus of 1.77 crore if we start today in another 30 years. I will repeat again, same amount of 5,000, 12% of return. If you start today, 30 year down the line, which is 2054, he will necessarily have 1.77 crore thanks to the power of compounding. Imagine that the person delayed by 3 years. Person is expected to start in 2027 instead of 2024. Same amount of money, same amount of return. By 2054, this amount will be 1.22 crore, lesser by 55 lakh. And if he delays by 5 years, which is if he starts at 2029 instead of 2024, he would necessarily end up with a 95 lakh corpus instead of 1.77 crore. And if he delays by 10 years, like most of us do, we delay our decision to invest, start a financial planning by 1 year, 2 year, 3 year, 5 year. And if the person delays by 10 years, instead of creating a 1.77 crore corpus, he would end up with just a 50 lakh corpus. So here is your money works in the long run. It keeps creating compounding effect, thereby money brings more money in the long run. Couple of generic messages on financial management, especially for people of Indian mentality, where we look to go behind this greed. And I think it's human mentality, nothing to do with India per se. So avoid greed and comparison. So focus on your own financial goals and financial management instead of looking and copying the neighbor or copying your peer group. So focus on your financial goal and resist comparing yourself to others, thereby avoid greed and comparison. Be prudent on loan repayment, loan management. So take loans only for productive purpose. Loan is a good leverage, which I think we're going to discuss in our future slides. But avoid excessive borrowing. Excessive borrowing can put you into financial stress and may ensure that if loan is taken, repayment is ensured. Expect uncertainties. All ours and our families are exposed to multiple uncertainties. Life has become so unpredictable, and so thereby prepare for uncertainties, unpredictability, and prepare for diversified portfolios and risk management. Independent decision making. Every decision, financial decision, don't go by social media says, but do your own research, ask all relevant questions, get clarity for that, and thereby you're able to take an independent, proper decision making about your financial management. And the world is changing in terms of its habit of saving money or investing. I'm sure each one of you can relate to your fathers and grandparents, looking at some of these investment options as a major avenue. Gold was so popular, and gold for long, long years, even today, gold has become an important investment vehicle, investment measure for each of our family. Chit funds, traditionally, that has been a saving plan. While it is not a investing plan, it is more of a saving natured investment avenue. Fixed deposit, the most favorite, guaranteed return, less of trouble. So just go there, park it, and forget it. And real estate used to be another lucrative investment avenue for decades earlier. From there, let's look at it now, how the world is changing, Indians are changing in terms of our habit. So when it comes to investments, please remember safety, growth, and liquidity must be ensured. So these three are the paramount. We call it as Trinity, Holy Trinity of investment, which is safety, growth, and liquidity of our capital. In diversification, like I mentioned, important for us. Informed decision making is important for us. Professional management is important for us. Like we go to a doctor for any sickness, we should go to a financial management professional for financial advice and timely review. So coming to a specific topic which we mentioned earlier, that everybody keeps saying that India is growing. And are we really growing? And also, second thing is, are we getting benefited out of those growth? Let's look at it, whether it is a myth or is it a reality. So currently, all of us are proud that India is now in fourth place in the world economic order, and it is expected to be the third largest by 2027. And hopefully, India will become a 7 trillion US dollar economy country as far as GDP is concerned. Today in markets, you would have seen that India has overtaken Japan as the most powerful nation tag. So India's story indeed is growing at multiple levels in manufacturing, in infrastructure, in digital banking, financial management, and so on and so forth. So let's look at it. What India is trying to do, what China did at 20 or 30 years back. China has grown from 1980s to 2010 to become the second largest economy in the world from ninth in the ranking earlier. Where India was not even there in the top 10, India possibly came into the top 10 league of World Economic Order in 2010. Next 10 years, which is 2020, we scaled up to sixth position. And currently we are at fourth position, and it is India is expected to be third largest economy in 2030. So these numbers speaks right, and the ranking changes accordingly. But let's look at it. The world, Indian International Monetary Fund's projection itself projects India at a growth of 7% on an average for the last 3 years. So India is expected to be a 7% GDP growth oriented country. 7% that we grow, expected to grow in this year. as compared to UK at zero point 0.5, Japan at zero point 0.9, China at 4.5, 5%. So these numbers may improve or go down depending upon various factors, including the geopolitical issues, etc. But when the world is growing at a 3%, India is expected to maintain a growth of 7% for so many years in the past now. So this is the financial number says. Now let us also look at it what each one of us are reflecting this growth as, or are we able to experience this growth? So let's look at the capital market formation through the mutual fund route. It is now last 10 years, 8 lakh crore investment in capital market or mutual fund or AUM has moved to 60 lakh, 58, 64 lakh as of today. So it has moved 6 or 7 times in the last 10 years. Digital transaction, which you can see to over the right side, has moved from 4% in 2013 to 76%. I agree, we all can resonate with it because all our payments have now become to a subsidy dealer. We pay through the UPI payments or Google Pays, etc. So digital payments today account two-thirds of India's total financial transaction. Foreign direct investment is grown up to $46 billion, and today some projection I was reading, it should become $100 billion in the next 10 years or so. Highway network it is growing up day in and day out, doubled in the last 10 years. Electrification of railways, 5 times it's gone up. GST collections, 2 times, it is 2.5 times it's gone up. So everywhere you can see the growth story of India unfolding in many of your relatable terms, which means you can touch and see this growth happening. As you all know, India is also happened to be the youngest populated country. Average age of the population is around 28 years. So it is one of the youngest populated country. Now, in the right side, you can see India's household income is projected to grow from from a top income group people from 8% in 2005 to 51% in 2030, which means most of us who have a proper income in place, who have a proper job in place or a business in place, who are able to manage your investment well, possibly we all will become upper and middle income group people there will be an evolution happening from or transition happening from lower income to middle income and upper income and high net worth income group. So this is all projected data by World Bank or IMF, etc. It is not at all created by us. So which means you can believe this data in a larger extent. Now, having seen the kind of India growth story, which due to the time constraint, we cannot run, this India growth story, research subjects are running 20, 30 pages every time. So we can't run all those for your short seminars. So with having seen that India growth story, now we should look at it whether we can get benefited out of it. How can each one of us can benefit out of it? There are different strategies from capital market to get, benefit out of. One is, of course, is a direct stock picking. So we can pick up with the fundamental and technical analysis going right, the right set of stock. Mutual fund is another instrument vehicle which pulls money from people like each one of us and deploy the money in right stocks, thereby creating a better revenue for us or income for us. There can be advised portfolios. There are portfolio management services, PMS, we generally call it as, and alternative investments funds, different ways. So we are going to experience some of it as we go. So we all know this famous story of somebody invested 10,000 rupees in 1994 in Infosys shares, rightfully so, and is reaping a 11 crore benefit as we speak today, right? So stock picking like an Infosys possibly would have given you a big income advantage or a growth story. But if you would have picked up some of the failed stocks at that point in time, all your capital would have been wiped out. So stock picking definitely can be a good addition tool, wealth creation strategy, provided that we have an individual. I mean, we have an enterprise, technical and fundamental skills available to review a stock and invest into it. But if that decision goes wrong at an individual level, possibly all the wealth what we have invested in will go in waste. Second one option is to put for those people like tech professionals who doesn't have possibly that much of time to be spent on investment decision can look at mutual fund as an opportunity to invest in, where there's an opportunity to invest monthly or a lump sum mode. You can pick up mutual funds with the short term, medium term, and long term objectives. Withdrawal can be done anytime, switch can be done anytime between different asset classes. All constitutions can invest, like individuals, NRIs, domestic, IT or non-IT, whoever can, can invest into. And based on our risk appetite, we can decide whether we want equity stock related mutual fund, government securities and debt related mutual fund, gold and silver commodity related, multi-asset mutual fund. So choice is vast as far as investment is concerned, selection of funds are concerned. Typically, one of the fund which we are just showing it here, invest into stocks at 67%, bonds at 8%, cash and gold, etc. at 5%, 19%, etc. So based on each individual risk appetite, return expectation, there are mutual funds which can help you to invest your money. I wouldn't use the term called saving, investing the money. Here we have, for your benefit, we have done a 20-year analysis, 22-year analysis on the four different asset classes. So you can see it in the screen, expand it and see. If assuming that one had invested 5 lakh rupees in 2002, which is 22 years back, in four different asset classes. One could have been an HDFC top 100 mutual fund. Another is Nifty 100 stocks, index funds. Or a third can be a fixed deposit. And fourth can be a gold investment tool. Had you invested 5 lakh 22 years back in all these four, that would have become a 3 lakh 63.63 crore in mutual fund, 1.65 crore in stocks, 22 crore if had it been in a fixed deposit, and gold it would have become 35 lakhs. So each of the fund has given an actual return of 21.6 for mutual fund, 17.21 in Nifty index fund, 7% in fixed deposit, 9.3 for gold. So understand the power of compounding. You can see it in the total amount which is delivered here. 3.63 crore versus 1.65 crore versus 22 lakh and 35 lakh, etc. So how traditional investment are much low, giving you much lower return compared to mutual fund, you can see it here. But however, keep it in mind, mutual fund has its own risk, wherein which fixed deposit is much more guaranteed. Gold, while it is not guaranteed, it has a pattern of investment. So this same, instead of keeping a 5 lakh rupees and growing it to 3.5 crore, you can also look at it. Each of us can look at it, investing into SIPs and creating long-term wealth like this. So a 5,000 rupees SIP over a 30 years period, growing at a 15% plus return can give you 3.5 crore as well. So there are different ways mutual funds can help you to create wealth over a period of time. PMS is another definite way of creating wealth for larger income group. So one can have concentrated stock portfolios to invest in PMS and can make good amount of return. So I'm seeing some amount of return here, that 25%, 37% year on year. There are PMS which can create, but also keep in mind the kind of risk associated with PMS, because it is for those people who can take risk and grow their money subject to market fluctuations as well. So anywhere we do a financial planning, keep these five things in mind. Right? It's easy to remember. One is risk, second is return, third is regulator, fourth redemption and review. Now, what is risk? Every investment we have seen, first principle should be to safeguard your principal. So look at it whether what is the chance of losing your capital itself. Second is then you ask for the return and who regulates this matters. So thankfully in India, some of this, we have some of the excellent regulators who helps us to, uh, build confidence in the financial system. There are uh, multiple investment if you can consolidate in the investment space from fixed deposit to mutual fund to to pension funds to gold. There are different classes of investment started giving you return of 7 to 8 percentage to 15 to 20 percentage in the past. This is what we have given is last 10 years return. And where risk is also increasing from almost nil risk in FD to moderate risk, high risk, and very high risk. You can also see who regulates all these funds in India. And the tax rate changes from slab rate of 10% to 30% to 12.5 when it comes to equity funds. So this is what Indian market operates offer you as far as different investment methods are concerned. And return also can vary from 7 to 8 percentage to 15 to 20 percentage. Risk also will be growing up from nil risk to very high risk. And most of the funds are regulated. Regulated doesn't mean that none of the regulator here guarantees your return. It is subject to various factors related to that investment. But it ensures that there is a law enforcing agencies in which you can only operate your business. And tax rate also changes from high to low when the risk also increases from investment to investment. Please keep it in mind that investments are subject to market risk. We should read the entire documents carefully before investing. It is just not statutory. It is also important in our own interest so that our protection is taken care. Now, coming to the tech professionals again, we are all busy with our day-to-day work. I have seen myself how projects are getting delivered with working overnight, day in and day out, weekends and weekdays and weekends. Now, thereby, we should be smart enough to ensure whatever investment we do with an auto debit. So do not think that you will be able to buy some stocks, you'll be able to buy some mutual fund and invest into different funds, allocating your time. Give an auto debit facility for SIPs, NPS, PF, insurance, etc., so that none of your goals will get defeated due to lack of time. And make it into auto managed route, which means don't wait for yourself to manage those stocks. Move into managed portfolios like mutual fund, like PMS, like ETF, etc. Autopilot ensure there are a lot of platforms available. So don't wait for the paper and pen approach of earlier. Don't wait, think that we'll go to that website, 10 different companies' website to invest, etc. Use aggregated 10 tech platforms like what we use Asset Plus to invest into various investments. And go, like I mentioned, go to that expert when it comes to financial advice. Don't only look at the social media advices or piece by piece meal which is coming in. Take informed decisions based on financial expert opinions. So any asset class, any income class, what you are in, if you're a beginner or you're a matured person or you're a high net worth customer, there are different financial products available in India which can cater to your need. This also goes with the risk what you face. And based on your risk, you can definitely take some of the investment which can give you better growth over a period of time. Having seen how investments can create financial well-being for each of you, now let's look at it. What is the big deal about loans, and is it actually worth taking some leverage at some point in time. So as you know, banks are offering or financial system is offering various loans, including mortgage loans, vehicle loan, secured loans, business loans, agri loans, etc., including education loan. So the loans are here to create wealth for you over a period of time, and ensure that it is used only for asset creation. Most of us use the loans, especially tech professionals. We have seen credit card spending, personal loans are hitting, skyrocketed, and you keep rotating your loan exposures by paying a much higher interest rate. So please ensure your hard-earned money should be used for your welfare purpose instead of paying at a 48% interest rate. So use it only for asset creation, use it for emergency purpose, and be prudent on loan repayment, because otherwise interest on interest will start hitting you. Credit rating is key. So your CIBIL scores are so paramount important. Have a check at it. Ensure that it is always above 700 plus. People keep asking us whether to invest the money which is available in our hand to build a home or to take a loan. So due to the time paucity, I will only tell you, look at this last column of the slide, saying if you are able to invest your in-hand money and also take a loan if your income permits you, then you will be able to grow. If that income scheme is giving you a 15% return, you will be able to grow 54 lakh net income after paying the loan EMI in 20 years' time. Nutshell is this: if you have surplus money available in hand, you can invest into various investment avenues which can give you better return than the loan rate of interest. Then on bank's money, you will be able to create a better profit, and loan will get repaid over the income which you generate out of your job. Yeah. Moving on to another important aspect. So we've seen loan, what are the do's and don'ts, and we are going to see what are the risks associated with the life. So there are generally life risk associated with it, health risk, property risk, liability, and cyber risk. And some of us are subject to this. Some of us seen that a health issue can create a trauma or a kind of a wealth erosion. Whatever hard-earned money gets, eroded with a health issue. So ensure that, let's look at it. We come across people telling us that I'm young, healthy, I don't need an insurance. Somebody says it is too expensive, so I will keep it open. Let the risk come in. People say life is full of risk. Myth number 3, and why bother? God will protect me, or I will face it as and when it comes. And many people, many of us think employer provides you certain insurance. So isn't that sufficient? Should I take a separate risk protection plans? Okay. People believe that they can create wealth, hence they don't require insurance. Right? So there are different myths people think and people believe. That's the reason why some of us do not want to take life or health or critical illness coverage, etc. So let's look at it, how costly these affairs are. Some of these myths we are going to burst today. So the life insurance is as cheap as your, some TV ads I've seen. It's like, one coffee per day can take care of your life insurance. People keep, in this example, you can see a 30-year-old to take a 1 crore life insurance. In general terms, it just require 13,000 rupees a year or 14,000 rupees a year, which run down to 1,100 rupees a month. Thereby, if you make it daily, it's a 30-40 rupees per day can take care of 1 crore life insurance for an individual. As the age progresses, the life insurance premium also increases, you can see. But it is constant for lifelong. If you're taking at 30, in 40 also you'll pay the same insurance premium. If you're taking at 50, same 1 crore insurance cost will be 39,000 rupees a year. So earlier the better. In life insurance, our piece of advice is when you're healthy, when you think that you don't require insurance, you must take it for the benefit of your family members. As you all know, life insurance is not for ourselves. It is for the people dependent on us. The reason for our, I mean, the reason for which we take a life insurance on our income. And ideally, it should be for 10 years. So we're covering that in the subsequent slide. Now, health insurance is all about taking a cushion against our medical bills. So today there are policies available where no age limit, even our parents and grandparents also can be enrolled into. There are unlimited restorations available, worldwide coverage available for certain policies. So please look at it policies carefully, and of course to have a health insurance scheme in place. Even if your corporate allows you to have a certain cover, because jobs are not sure how long you will continue with the company. When you come out of it, if you have a medical illness already or a health issue already, you may not be offered a health insurance by a company, or company will ask you to do all medical tests to ensure that you're fit to go for a health insurance. So thereby, when you're healthy, when you're corporate having companies having a health insurance already, take a additional cover, a top up cover, so that the premium is low and the coverage will continue, and it'll come in handy once your corporate insurance limit is exhausted, corporate cover is exhausted. Generally, life insurance, you should take it for 10 years of income to 20 years of income. If you are young enough, the longer years you will live, hence your family require larger amount of your sum assured. So you may go for 20 years. If you're after 40, 45 and all, you may settle for a 10 year of annual income as your insurance premium. So consider a lot of these factors, your debt, liabilities, children's education, etc., before taking a insurance policy and the right amount of sum assured. Because you're taking insurance not for yourself. In case of an emergency happens to your life, your family gets immune or protected against the future income losses which may arise. People keep asking that why do we plan for retirement so early in life? So why not after retirement we invest into some schemes, and isn't that sufficient? So the answer here is the inflation as a cost factor, which we have seen earlier. As per the current inflation rate of 7% in retail inflation rate, your 100 rupee cost will become 760 rupees after 30 years. 7 times it is expected to increase in 30 years of time. So if you can live your life in this example, in this right hand side sheet, which you can see, a 25,000 monthly income today would require 1,90,000 after 30 years to have the same cost of living, right? So if you are living at home with 50,000 rupees today, it require 3,80,000 rupees after 30 years. Your 1 lakh cost of life today or cost of living today can cost you 7,60,000 after 30 years for the same kind of a lifestyle management. So unless you plan for an investment also, which will grow along with your inflation, you may not be able to live life like this, and you will have to start compromising. So thereby, a retirement plan helps you to tide over, and there are so many plans available in the industry today: a pension plan, a EPF, or a mutual fund pension plan, a national pension system, the public provident fund, and so on and so forth. So ensure that you subscribe to one or more pension plan for your future, because retirement is certain. It is going to happen for me and you. Moving on to fraud and risk associated with it. Today, from cryptocurrency to foreign exchange trading to everything, we see people advising us to go for, and with an assurance or a kind of commitment that money can be money. Sorry, yeah, the money will grow multi times in no time. In short time. There is no free lunch. Please understand, there's no free lunch unless we create a kind of awareness against the frauds happening around, which can be in the form of trading advisors or investment advisors or betting advisors or even higher income offered product. Unless we do a due diligence, you might end up losing all the money. Last but not the least is take tax benefit out of every financial decision which you take, be it investment, loans, or otherwise. So this is to sum up to you telling that if you are a fixed deposit customer, if you are able to intelligently move into a hybrid mutual fund, your post-tax return can be double, 2x than what you get it in fixed deposit. And if you're able to take little more risk and put into an equity mutual fund, your return can be 3 times of what you can get it from fixed deposit. That is why you see, remember the slide, we have seen 8 lakh mutual fund investments moved to 60 lakh in a 10 years period of time. But everything has got its own risk associated with it. But I'm sure an informed client, informed advisor will be able to give you right set of information. Now, we all have this dilemma in place. In 20s, we think that too early to plan for a financial management, right? We think that's the time to get a job and to spend time with all friends. And then that's why we don't tend to go for a financial planning. In 30s, we think, oh, just got married, having, family setting up. So let's have some more time to plan for finance. In 40s, children's priorities will take over. In 50s, settling down will take over, and by 60, it will be too late. So financial planning, to start a financial planning for all of you tech professionals, I would suggest you this is the right time. Today is the right day. Unless you start a decision and start today, tomorrow will never happen, and next year also you will think that we should have planned for it, but that we should have will continue than planning for it. Just to sum up on today's session, any other professionals, tech professionals are also equally pressured and having its own challenges. So there is an India growth story which we can all benefited out of it. We've seen inflation, how it is eating up, how investing is different from saving. So we should differentiate from saving to investment, taking benefit of India growth story. We should start early so that we are able to create and take advantage of power of compounding and create wealth over a period of time. Loans are a good leverage tool. Good when you are earning only, you can take a loan, take it for the right purpose, and create asset against the loans which you take. Be careful about overspending, credit cards, and personal loans, etc. Take protection against risk, various risks associated with life, which is life risk, health risk, cyber risk, liability risk, property risk, etc. And take adequate protection so that your hard-earned money stays with you. Plan early for retirement. Certainty is that you will retire one day and you would require a better income stream over a period of time to live a quality of life what you desire to. Take tax benefit wherever it's required. And we call this three as lifeline of each one of us: mutual fund, SIP, health insurance, and life insurance. Of course, you should go for diversified asset classes like what we were talking about to de-risk yourself. Create a culture of financial discipline. No free lunch. So we will have to create our own hard-earned wealth. Work as much as you can so that your life expectancy today is 85 plus. Don't think that all of us will die at 50s and 60s, etc. Some of us might even see 100 because medical system, everything is improving. So unless you create a proper financial plan in place, your continuity with the same lifestyle can be different. Budgeting is important aspect. Manage wealth, ancestral wealth even better. Keep greed away. Prudently repay debt and study every financial decision. So we at Trinity practices this, as Soumya mentioned about it. Our vision is to create financial well-being for all individuals, families, whoever is associating with us. Good for customers and good for approach we follow. And our mission is to bring in excellence in whatever we do, and we create value for we create our core values are trust, transparency, and ethics. So anything and everything we do, we focus on these three items. Our products and services are vast, from investment, from fixed deposit to say alternative investment. There are 8 or 9 different classes of investment we cover. Demat and trading, we offer all entire services. Protection and risk management, we cover different insurance solutions. Banking advisory, we cover on structuring of loans, etc. We are a one-stop financial shop, rich experience in banking, best products and better partnerships in place. We do a financial, periodic review, where thereby your wealth stays fit and growing all the time. So we have some of the best industry tie-ups today in the country, where we have some of the best financial partners for PMS, insurance business, for loans purpose, for mutual funds, for fixed deposit. So we ensure that the quality partners are always maintained to provide you uh, the kind of right financial advice to you.